Well, with Indian markets seeing volatility at the start of 2024, today we try to understand how and why Indian investors should diversify their investments into global markets to hedge themselves from the volatile Indian equity markets in 2024. This is Smart Money, and today we're going to talk about the big learnings from recent bear markets and how do you structure your global investments. Devina, Mehra, the founder, chairperson and managing director of First Global, is joining us on Smart Money today. Devina, thank you so much for being here with us on the show. It's been a while since we spoke to you, and the markets, right? The markets have been terrific since we spoke last.
Thanks, Sonia, for having me, and always a pleasure to talk to you. Yes, but I mean, the markets have been up and down and overall up, which is what I expected. But then when we talk of global diversification, it is not from a one-year perspective. It is not as if that we expect Indian markets to underperform for 2024, and therefore we should look at global markets. The global diversification theme in your portfolio has to be a more long-term thing, that over a period of time, you have a significant portion of your portfolio outside India as well.
You know, since you primarily sit outside India, you have a better viewpoint on how things are panning out, right? Investors in India generally tend to be attracted to that familiarity bias. I know the Indian market, so I invest here. So for those people who are perhaps looking to invest in global markets, why should I put my money in global markets if India is amongst the fastest growing economies in the world?
Yes, I get this question all the time, Sonia, that if India is the, or at least one of the fastest growing economies in the world, why should I look elsewhere? And let me take you back 25 years. And in the 1990s, which were the fastest growing economies in the world? They were the Asian tigers. The Southeast Asian countries were termed the Asian tigers simply because they were growing at those stupendous growth rates. And yet, almost little over 25 years ago, there was something called an Asian crisis. So the younger generation could probably Google that. And in just 1 year, all those markets, between the market and the currency, fell between 50% to 90%. 50% for Taiwan, 90% for Indonesia, and Thailand, South Korea, Philippines, all of them in between that 50 and 90. And that for me personally was a wake-up call that this is the danger of being in a single market, that if I was an Indonesian investor, I would have lost 90% of my net worth in a year's time. And that, I mean, as an aside, was the impetus for First Global to go global. So on the London Stock Exchange in 1999, we were not just the first Indian, we were the first Asian firms to become a member in the next year of the NSD. But that's a story for another time. So this is one that even fast-growing economies can see hiccups. Second, India, while it has been moving up the rank charts, India's market cap is still only less than 4% of the world market cap. So why would you want 100% of your money in what is only 4% of the world? The other important thing, the rupee depreciates over a period of time. When I started my career, when I was 21, the US dollar was 12 rupees. Today it is 83 plus, which means a 85% depreciation in the course of less than a career. So when you're talking long-term financial goals, long-term financial planning, you cannot let go of the sight of the fact that you need to be outside India. Also, depending on the age of the viewer, you or your child may be planning to study abroad, maybe start working abroad, which means that you will be traveling overseas. I see many people now after retirement spending part of the time overseas because the children are there. And which means that you have hard currency expenses. So which means that you should not have all your assets in rupee denominated assets. And as I said, this is not a one-year call. I'm positive on the Indian market for this year. I would even say that India will outperform the globe as we stand here today. But over a period of time, I would suggest that you should move maybe around 20-30% at least of your assets to global markets.
Okay, that's a very important point. So you're saying move 20-30% of your assets to global markets. And you know, children's education by and large is now one of the biggest goals, right? Apart from retirement, biggest financial goals that people talk about. And I take your point, you need to diversify in order to hedge yourself from the depreciating currency as well. So why don't more Indians think global, Devina?
See, Sonia, part of it is that every country has a home country bias. So this is true that every country investors will invest more than what is in a sense necessary in their markets. Canadian investors of their equity money put 60% in Canada. Canada is nowhere close to 60% of the world market cap in equities. But in India, it has become much more skewed because initially, for a very long time, we did not have capital account convertibility. Not just when I was a student, for a long time after I started working also. And some remember a time when you're traveling abroad, also you could take only $20 each time and $500 once in 3 years. So that was the law.
Yeah.
So traditionally, we grew up without thinking that there was this pool available where you could invest, which was outside India, because you could not invest outside India. The only way to get a kind of currency hedge was through gold. And maybe that's part of the reason why Indians are that fond of gold. But other than that, there was no way. But now liberalized remittance scheme has been around for a while, and it is pretty generous. It is $250,000 per person per year, which means family of 4 can remit $1 million, which is over 8 crores in a year. So it's like, beyond what anyone would need to invest in most cases. So it is very generous. Remittance also is pretty fast, but the mindset is still not really changed.
Absolutely, absolutely. That is the biggest thing, right? The mindset needs to change. So for all our viewers who have perhaps a large chunk of their money in Indian investments and want to diversify, how do I start my global investing journey? What's the 1, 2, 3 steps that you would advise?
Okay, so now there are 2 ways in which you can, broadly speaking, globally diversify. One is using domestic money. That is not the liberalized remittance scheme, but just your domestic money. You can invest in mutual funds that are partly or wholly investing globally, their schemes. Now, the issue with that is, one, I looked at all the mutual funds that have a global mandate. Most of them have a very narrow mandate. So it will be either NASDAQ or US or maybe China or Asia. Hardly any invest globally, truly speaking, across geographies. None of them invest across asset classes. That means fixed income and equity and so on. So your choices are limited when you do that. And there are other 2 things. One is that the expertise to manage global money doesn't lie in India by and large, because the fund managers also have not been exposed to global markets by and large. So what happens is that most of these funds are feeder funds, or they are fund of funds. So they're adding a layer of costs here without anything extra being provided to you. You can as well today open a brokerage account for your LRS and buy the same ETFs that they are buying. So that, and also, because the funds are not being managed here, there is no accountability. So that's the non-LRS. With the LRS, you can open a brokerage account, you can buy stocks directly, you can buy ETFs or global funds, or you can buy, if you just want to buy NASDAQ, then you can as well buy a NASDAQ ETF without any extra cost. But I would not advise that. So, and the other option is to have actively traded funds or portfolios, which is something, for example, we offer, because this is a cause for me to get Indians to think global, to at least make a start with global diversification. So we have multi-geography, multi-asset funds, which start at $10,000, which is just about less than 8.5 lakh rupees. I can tell you that kind of investment is not available for less than $1 million elsewhere in the world. So those are the options broadly, that you can invest through mutual funds, which has its limitations, or you can open an LRS, open a international brokerage account with LRS and use that to directly buy funds, ETFs, stocks, whatever.
Got it. But for people who have zero exposure, just to follow up here, right? I mean, do feeder funds or fund of funds, is it a good option? Because it's at least better than having... I understand you talked about how narrow the approach is and the fact that fund managers here really don't have that kind of exposure to global markets, but it's better than zero, right? So would you advise some of these feeder funds or fund of funds as well?
Actually, the thing, Sonia, is that no asset class, no theme, no geography does well forever. Yeah. So which is why, as a policy, as a philosophy, I am against thematic funds. So if you buy NASDAQ, you're exposed only to NASDAQ. So, I mean, for example, a lot of NASDAQ funds came in 2021 and not now. Even at that time, I said, you are looking at the fact that NASDAQ has done so well for 3 years, that's recency bias. Just because it has done well for 3 years doesn't mean it will do well forever. I mean, just to give you a benchmark, in the 2000 tech crash, the NASDAQ high that was made in 2000 was crossed a good 3 years later in 2015. So that's how long a certain geography or a certain type of investment can underperform. So which is why if you get locked into, let us say, a US index, US and India together are maybe better than India alone, but not by much. I mean, US is still just one more country. So philosophically, strategically, I'm against a single theme, whether it is like in between, there were Greater China funds, there were tech funds, and there will be periods when a theme does well. I'm not saying that there won't be. I mean, 2023 is a good example of when only the tech theme did well in large part. But that leadership always changes, which is probably, I mean, what we will be talking about a little later, or, what I mean by that permanent bull market, and which is precisely that the theme changes.
Okay, let's do one thing. Let's take a short commercial break, but don't go anywhere. We'll come back and continue to talk about how you should diversify your portfolio by investing in the global markets, and we'll tell you how to do that in just a bit. Stay tuned.